Greetings, my name is Kevin Matthews and I am the tax professor. I want to welcome you back to class. Remember, class is still in session because the learning never stops. And so today what we're going to be talking about is the foreign tax credit. This is actually the third video in this series. And part of the reason why we are doing this is that one of the typical things that happens is when I make videos, I go ahead and I upload those videos to YouTube. And then I kind of take some time and I actually do some review of the video, and I go ahead and make sure that everything looks good, everything uploaded correctly. But as I was reviewing it, I was noticing that there were certain gaps that were existing in between what I wanted to really talk about in the previous video and what I'm talking about in this video today. And so as a result of that, I decided that I would go ahead and I would talk about this video where we're going to talk about the differences between the passive and the general baskets. And part of the reason why I wanted to have this done is, in addition to seeing some of the gaps, one of the things that we do here at Beta Solutions, we're a very common thing that we do is we do international tax returns. This is sort of a big block of our business. And so one of the things that sometimes will happen is people will reach out to me and they'll say, "Hey, Kevin, I had my taxes prepared by another preparer. I had some foreign income, and as a result of which I got the foreign tax credit, but I'm not 100% sure that things were done correctly." Now, something that was once shared with me many years ago was that the international tax arena is probably a comfortable place for most people to be in about 3% of the time. So in other words, 3% of CPAs really feel comfortable working in this. And so as a result of that, one of the things that I've tended to notice is there seems to be a lot of times where the foreign tax credit isn't necessarily taken correctly. And so I wanted to kind of talk a little bit about some of that. And one of the most common things that ends up happening is placing tax credits in the wrong basket. Now, generally speaking, something I've also noticed is that the IRS probably isn't as aggressive in enforcing this area as much as they could be. But I have participated in a couple audits where the IRS has come back and said, "Hey, wait a minute. You said that you took, foreign taxes from this basket, should have been this basket." It's happened a couple times to me, but I don't think that they've been as aggressive, industry-wide, as I've talked to a lot of CPAs, and they're kind of like, "Yeah, I just do it," and they really haven't done much to me. So I wanted to take some time to go over this and shoot this video in order to do that. So the first thing I want to talk about is sort of a review of the foreign tax credit, as we've talked about in the first and the second video in this series. And by the way, if you haven't seen the first or second video, please go ahead and take a look at those videos. I'll put the link up on top. And one of the things that we kind of discussed, I kind of blew over it because I didn't want to get too far into it. But in 2017, prior to 2017's tax reform laws that was passed, the United States was what we would call a worldwide income tax system. And so basically what that means is that being a United States resident, being a United States citizen, the way the IRS kind of looks at it is, we're going to tax your income no matter where it's earned in the United States. Now, this is in contrast to how many tax jurisdictions work, where a good majority of them are what we would call territorial systems. And so very good example is Germany. As you know, in my last video, I tend to use Germany as a very good example because I know it pretty well. Germany is a territorial tax system. In other words, what happens is that if you work in the country of Germany and you live in the country of Germany, whether you're a citizen or whatever, they have a right to tax your income when it's earned within their territorial boundaries. And so if you're going to leave their territorial boundaries, you need to send a document to the German government that basically says, "Hey, I'm no longer a tax resident of Germany, and as a result of which, stop taxing me." And so that's usually what ends up happening with our German nationals who come here to the United States. They file that document, and then they're no longer taxed in the jurisdiction of Germany. The United States doesn't have that system. And so what happens is that a United States citizen will go to another country, for example, Germany. They'll work, and what will happen is that Germany says, "Okay, we can tax your income that you've earned because it's in our borders," which is legitimately legal. And say, for example, you make $100,000, they'll go ahead and say, "Well, we're going to tax you at $100,000. Well, the United States is going to tax you on that exact same amount in the tune of $100,000. Now, that sounds like double taxation, and where you're talking about Germany, where the tax rates can be 40 to 50%, as some of our clients run into, in addition to which an additional 20 to 30% here in the United States, you could see how this could eat your income up, if there was no relief provided. And so the IRS actually provides two forms of relief. The first form is going to be the foreign earned income exclusion, which we'll kind of talk a little bit more about here in a little bit. But the second thing that they actually do is this foreign tax credit. So their idea is that if you go to another jurisdiction, you pay the jurisdiction those other taxes, what's going to happen is that you're going to receive a credit for taxes paid to that other jurisdiction. Now, there's certain limitations that have to happen, and we've talked about some of those in the previous video, but we're also going to talk about them in some of this video. This is the Form 1116, as we've talked about in the past video. This portion right here, where it says obviously name, identification number, which of course is going to be your social security number if you're an individual, or if you're a trust, it'll be your EIN. But what it does is that there's an 1116 has these 7 baskets, so to speak, and that's a term that's widely used in the industry, where they talk about these different types of baskets. Now, in the past, there was a significant reduction in the number of baskets that they had. In the pre-2017 tax rules, what ended up happening is that we would basically have it pretty much was just 4 different baskets. They've actually increased this to a total of 7 baskets. And that's what's happened with, the move in 2017, where we moved from a worldwide tax system to what we call a quasi-territorial tax system. In the quasi-territorial tax system, what happens is that some aspects of worldwide income, where we can tax you no matter where you exist on the earth, and the territorial system, where we can only tax you if you are earning income within the territories of the United States, it was developed this way. And part of the reason why they did this was the worldwide income system that we developed in the U.S. created an unfortunate side effect where people would make money overseas, but then they wouldn't want to bring it back to the United States because it would then be taxed again, and the tax regimes weren't favorable for them to do that. So they wanted to bring that cash to the United States, and the thought process was they were going to take this one-time tax, use that money in order to go do infrastructure improvements. The infrastructure improvement still has not been approved by Congress as of the making of this video in 2020. So, as far as I probably know, the money's gone. But what happened is, as it moved to that quasi-territorial system, they created some additional tax baskets, and we're not going to talk about all these. I mean, something that you probably realized in the last video when it went through is that we went way overboard in terms of how much time we spent with it. And so I really want to focus on these two right here, which is the passive category income and the general category income tax systems. And so let's talk a little bit about sourcing to begin with. So sourcing of the income is important because we need to determine where was the income earned so we can learn who has the legitimate right in order to tax it. Now, if you remember in the previous video, we in the second part of that form, we showed you the top part of the form here. Then there's another part that's down below. They ask you to split off all of the different types of income tax that you paid to various jurisdictions and the income that's sourced to that country. And part of the reason why the IRS does that is because what they're going to do is they're going to take the income that you earn in that other jurisdiction, and then they're going to calculate it under our jurisdictional rules and see what the tax would have been, because you're only going to get the foreign tax credit equal to either how much you paid on the tax or how much it would have been taxed here in the United States had it been fully taxed in the United States. Now, if there's any overage on that, so if you come under the second regime where they don't allow you to take all the foreign tax credit, don't be worried. You still have those foreign tax credits to use in future years, provided that you have foreign sourced income within that relative basket in order to get that taken care of. And the example that I'm going to use here is that Sarah works in the country of Ireland for 9 months, earning an annual salary of $100,000. So Sarah is probably somebody who's working overseas, and as a result of which, Sarah's working during this time for this example, she's working for 9 months in the country of Ireland, and then she's working for Germany for 3 months. And so what we would end up doing is we would say, okay, she spent 9 months out of 12 months in Ireland, so 75% of that is going to be allocated to Ireland, and then 25% of that is going to be allocated to Germany. And so what ends up happening is we will have to fill out the form where, we put in those bottom boxes, one for Ireland and then one for Germany, and then how much income was earned in there. Now, a secondary thing, and this is the second example, relates more to the passive example, where Jim has an investment account in Brazilian stock because he's, the company is headquartered in Brazil, where he receives $100,000 in dividends. This is 100% sourced to Brazil. Now, the big question that sort of gets begged here is, if the Brazilian company has income from other parts of the world, so for example, maybe it's headquartered in Brazil, but maybe it has locations all over South America, do I have to go back and allocate those dividends to those various sources where it happens? And the answer is no. The way the IRS determines in sourcing rules is that when you're receiving interest and dividends, it's going to be where the company is actually headquartered. That's going to be used as the example. So, for example, if you have a company that is headquartered, say, in Germany, and then it has various interests that it has over in, say, Bermuda, some other low tax jurisdictions, maybe even Singapore and all that stuff. That stuff is going to be brought back to Germany, taxed in Germany under the German tax rules, or at least potentially taxed in Germany under the German tax rules. And then what happens is when they pay the dividends out to the U.S. shareholder, it's going to be sourced 100% to Germany, because the way that they're going to see it is that the German headquarters is the one who made the control in order to allow that to happen. So that's how our sourcing happens. So getting sort of to talk a little bit about the general basket more in detail. The general basket used to be sort of a catch-all basket, which basically means that taxes were not paid in any other basket. And so usually what ends up happening is, so for example, if it falls under the passive rules and it goes into the passive basket, it's in the passive basket. If it falls under the, the treaty resource, income resource by treaty, it falls into that basket. It doesn't go into the general basket. Everything else kind of went into that general basket. As a result of the Tax Cuts and Jobs Act of 2017, they've actually increased the number of the baskets, and as a result of which this basket really is kind of getting to what its intended focus was, which is more towards the idea of it being used for wages and business income earned overseas. So if you're a person who lives and works in Germany, and say you work there as an employee, it's going to be wages that's going to be sourced to Germany, and that would be a general basket tax item. And then if you have business income, so maybe you're an independent contractor working in Germany, so you live and work in Germany, but periodically you're traveling all around different other countries, what ends up happening is that that's going to be business income that's going to be sourced into that general basket. Now, so it's still a catch-all for all those taxes which don't fit into the other 6 baskets as it exists. The passive basket. Now, when you talk to other CPAs about the idea of passive income, passive is essentially, it's actually defined in the code and under code section 469. Now, the reason why this code section was passed many years ago, it was actually passed in the 1986 Reform Act, which was the biggest reform that we had had in taxes since up until the 2017 reform. But typically what ends up happening is that back in those days, there used to be an idea that you could purchase what's called tax shelters. So what would happen is somebody would have, a business that took place off in, wherever. A very common one that we saw frequently was the use of orchards. And so, you'd have apple orchards that are up in Washington, and what would happen is they would sell a portion of the partnership that manages those orchards to limited investors. And investors would purchase those partnership interests partially because they would earn a little bit of money from that, but then also they would have an additional amount, a significant amount of passive. Well, it wasn't called passive back then, but it would be a lot of losses that you would be able to take on your tax return. And so the purchase of these tax shelters, as they used to be called, was severely criticized. It was basically causing the government thousands and thousands of dollars every year by each taxpayer, and so they wanted to get rid of it. And so what they did is they created 3 separate buckets, so to speak, where they created active income, passive income, and portfolio income. And passive income, as is defined under the 461 subsection C, paragraph 1, basically involves the conduct of any trade or business in which the taxpayer does not materially participate. Now, material participation, I've kind of talked about it in some other videos in the past. It's kind of like love, when you're in it, kind of thing. There is actually, materially participate is not specifically defined in the code, but there are some ways where they've created some mechanical tests that say, hey, if you've got these certain circumstances that take place, you are not considered materially passive. Now, one of the very interesting things is that under most code sections, the IRS will typically write about 2 or 3 different regulations in order to manage how the IRS is going to interpret what Congress passed in that and apply it in the tax code. In this case, they've written, last time I checked, that I know there was more than 11. This is an area where the IRS has seen a lot of ambiguity, and as a result of which they've tried to establish some rules so that they can enforce the intent of the law as it was written. Now, another thing about the passive rules is that rental real estate is automatically considered a passive activity under 469 subsection C, paragraph 2. And in order for it not to be considered passive, you have to qualify as a real estate professional, which is actually an election you have to do, and you have to meet some very strict requirements in order to be able to do that. Now, that's general passive as a rule, but how does this work in terms of the foreign tax credit? Well, the passive rules for the foreign tax credit are actually more expansive, and if you go look up the foreign income tax limitations, which is Code Section 904, they'll actually talk about a reference to Code Section 954 subsection C, which basically defines passive foreign holding company income. And they said, anything that is passive, under the passive foreign holding income of foreign company income is going to be considered passive for the terms of the foreign tax credit. And so you have, under the foreign passive tax rules, passive is far more expansive. Not only does it include rents, royalties, and annuities, it also includes dividends and interest. So basically all of the portfolio income pretty much falls under the passive rules. Certain property transactions, commodity transactions, foreign currency gains, income equivalent to interest, notional principal contracts, payments in lieu of dividends, and then this thing that we call PFICs, which is passive foreign investment companies, that that's actually a completely different regime under which the majority of foreign mutual funds are going to fall under this. And sort of the idea was that they wanted, the United States wanted it to be where Americans were really investing in financial instruments where the IRS had total complete transparency over it. And when you start investing in foreign investments that are outside of the United States, that transparency starts to diminish. Now, obviously, first world countries, for example, Canada, Germany, France, England, transparency is not going to be impossible. It's going to be a little more difficult for the IRS because they don't have any jurisdictional control over that. But, if you're investing, say, for example, in mutual funds, say in, and I don't want to pick on any countries, but, if you're, countries over in Asia, or maybe they haven't really developed their mutual funds markets as much as they would like. But that's where they could typically run into some issues. Now, the foreign tax credit does tend to run into other rules, and so it's important to really understand how those other rules play into the foreign tax credit, especially when you're talking about things like PFICs, control foreign corporations, branches, and things of that nature, and so you want to make sure that you're taking care of all of that. All right, so that's all I've got to say about this topic today. I want to say thank you very much for participating. Again, if you like this video, please go ahead and hit the like button. We'd really appreciate that. And if you like the series of all of these videos, we would appreciate if you would go ahead and subscribe to our videos, and that way we can let you know when more of these are going to come out. And if you want to reach out to us for a more one-on-one conversation, you can reach out to us at Beta Solutions CPA, and that's going to be at www.betasolutionscpa.com. Again, that's www.betasolutionscpa.com. Thank you very much for watching our video.